Could the very thing that makes index funds appealing also turn them into a risky investment? Let's find out. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. When might index funds start to become unreliable? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, imagine someone diving into the world of passive investing through exchange-traded funds, or ETFs, that mirror broad market indexes. They've heard it's a great option for those who don't have the time or expertise to actively manage their investments. However, they're curious about how much these index funds rely on active investors making market decisions. They're concerned that as more people flock to index funds, the influence of active investors might weaken. This raises a big question for them. Could this shift reach a tipping point where index funds lose their effectiveness and potentially shake up the entire stock market? Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's noted that active management tends to decline when too much money chases limited pricing errors, but it can bounce back if more opportunities arise. Pension and endowment funds prefer active management to beat benchmarks. Meanwhile, technology enhances market efficiency, keeping prices responsive even with more passive investing. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. One response points out that the market adjusts prices as traders buy and sell based on new information. It also suggests passive investing may overlook individual company performance, while active managers might criticize it because they lose clients to passive funds. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that as active funds decline, individual stock pricing might become less rational, leading to more underpriced stocks. This could make it easier for skilled active investors to achieve higher returns. Meanwhile, passive investing remains effective because of its low costs and efficiency, even with fewer active investors around. All right, now that we've seen what the community had to say, here's our take on this question. If index funds start to dominate too much, they might become unreliable. It's important to have a balance between active and passive investments to keep stock prices accurate. Index funds don't adjust quickly to rapid market shifts, whereas active funds can respond faster to changes. Relying too much on index funds might reduce market efficiency, since active investors help correct mispriced stocks. So in this video, we've covered how a balance of active and passive investments keeps stock prices accurate. Active investors help correct mispriced stocks, while index funds may lag in fast-changing markets. Over-reliance on index funds might lead to less rational pricing. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.